Chapter 6, Risk and Risk Aversion. And what we're doing is going to build a model of portfolio choice. And we're going to do this across Chapter 6 and Chapter 7. The textbook breaks this up into two separate chapters, so I'll do the same in terms of how I organize it. But really, this entire model derivation flows across these two chapters. And what we're trying to do, and you can see the outline of the material here, what we're going to try to do is build a model of portfolio choice, asset allocation. Given an investor, given an investor's wealth, given some criteria associated with that investor that are going to be risk aversion and some sort of time horizon, we want to know what an optimal investment strategy is for an investor, given an investment universe. What is available for this investor to invest in? Is it going to be 2 stocks? Is it going to be 10 stocks? Is it going to be 1,000 stocks? Is it going to be stocks and bonds? And so given some investment universe, given some criteria about the investor, we want to figure out the optimal investment strategy. And the end result is going to be something called the Markowitz model, which is a standard model of how an investor can achieve a portfolio with the best, and we're going to say optimal, risk-return trade-off for a given investment universe and personal level of risk aversion. But to get there, we're going to build this model in stages. We're going to start with a very narrow, very restrictive investment universe and a very simple model of what an investor looks like. And then we're going to slowly remove these restrictions until we get something that looks a lot more like real life. So we'll start with 2 available risky assets with the unrealistic restriction that you can only invest 100% in one asset or 100% in the other. Next, we'll let one of these assets be the risk-free asset and the other be a risky asset. Still 100% in one, 100% in the other. Next, we'll still only have the risk-free and one risky, but we'll allow any weight in these assets. So you can be 0% in the risk-free and 100% in the risky, 1% 99, 2% 98, and so on, to try to figure out the best allocation. Next thing we'll do is we'll say, well, what if this risky asset is actually made up of 2 risky assets? It's a portfolio. And then we'll let it be 3 risky assets and N risky assets. And then we'll start varying the time horizon. So again, the end result is this Markowitz model. It shows how investors can achieve a portfolio with the best optimal risk-return trade-off for a given investment universe and personal level of risk aversion and time horizon. Now, the model is horribly flawed. There are some real issues with this model, and we will talk about these as we build the model. But it is ubiquitous. It's used in many portfolio decision situations. Lots of retail investing, lots of InvestSpots, life cycle funds. But as flawed as it is, it still gives a really good understanding of the risk-return trade-off that we all face as investors and that all investors are going to face. So we will proceed through chapters 6 and 7, building this model, fully understanding the flaws, but also understanding how ubiquitous this model is. We'll start with our simplest investment universe. We're going to have 2 assets, asset X or asset K, and we're only going to be allowed to put 100% of our money in asset X or 100% of our money in asset K. And each asset has an expected return and deviation about that expectation, and we're going to plot them in risk-return space. And so I have risk, standard deviation, on my X axis, and I have return, expected return, on my Y axis, and I can see that asset X has some level of risk and some level of return. It gets plotted here. And asset K has less risk. It's to the left of asset X and greater return, so it's above asset X. And in our simplest set of allocations, in our simplest investment universe, we can see that asset K dominates asset X. It has higher return and it has lower risk. And so we will go with the assumption that all investors, given this universe and choice set, would choose to invest 100% in asset K and not 100% in asset X. Now, this essentially assumes that investors have 2 things. One is that they have information, they know the expected return and deviation about that expectation or risk for each asset. So they have the full information set here, which is return and risk for each of the 2 assets, and that they're going to act rationally. that all investors will choose the investment that dominates. And in this particular case, regardless of anything else about your personality or your risk aversion or your time horizon or any other investment criteria, in this simple universe, you have full information and you act rationally. And these are assumptions that we are going to make and continue to make. So next, we're going to add assets I, J, and L to our investment set. And so now how do you choose between these assets? And I'm going to adjust this a little bit. How do I choose between these assets? Well, now I add I, J, and L. Let's think about this. I have 4 quadrants, and so X is in the middle of the quadrant, and I can see that anything that's in quadrant 1 dominates X. It has lower risk, it has higher return, and so everyone would prefer everything in quadrant 1 to asset X. And I can also see, similarly for asset L, anything in quadrant 4, X is better because X is going to have less risk and greater return. And so I can see that X dominates L and K dominates X. We're done. That's super easy. Where this becomes confusing, where this becomes complicated, where we have issues is, what about I versus X and X versus J? K relative to X is easy. X relative to L is easy. But I versus X and X versus J, this is when it becomes trickier. So we know that given return dominance, choose K over X because everything in 1 dominates X. Choose X over L because X dominates everything in quadrant 2. But what about asset X and asset I? And what about asset X and asset J? There is no dominance over quadrant 1 and quadrant 3. So we need to figure out some other way to choose between X and I and X and J. And so what we're going to do is introduce utility and utility preference. We are going to define some benefit that investors receive from investing in different assets as a function of expected return, the risk of that asset, and some risk aversion parameter.